Today we will look at the chapter 21, cost of capital. The agenda is finance diamond, components of the cost of capital, a weighted average, the optimal capital structure, and we will solve some problems and wrap up. As you remember, we have the finance diamond, savers, borrowers, indirect and direct transfer of funds, financial institutions, and financial markets. We will look at the toolbox, present value, future value formulas, perpetuity, annuity formulas, return formulas, risk measurement. And now we will concentrate on the decision toolbox, which is net present value analysis, cost of capital, net present value, and IRR. As you remember, in chapter 11, we look at the stock valuation, and what was the process used to select a stock in chapter 11, which was stock valuation. One answer to that question is that you determine the value of the stock and compare the value to the price of the stock. That is, you discount the future cash flows to determine the present value. If the present value exceeded the stock's price, you bought the stock. If the present value was less than the price, you would sell it if you owned it. If you did not own the stock and were willing to bear the risk, you would sell the stock short. Alternatively, you could have estimated the stock's return compared with your required return and act accordingly. If the expected return exceeded your required return, you purchased the stock. If the expected return was less than the required return, you sold it. Either technique leads you to the same conclusion. The only substantive difference between the two is the units. Valuation is expressed in dollars, while returns are in percentages. The process of making investment decision is the same for a firm's manager. They either compare the present value of future cash inflows with the current cost of the investment, or they compare the investment's expected return with the required return. The terminology used may differ from the terms used in stock selection, but the process is the same. So the process for investing in plants and equipment requires an estimate of cost of funds used to finance the purchase of an asset. That cost is referred to as the cost of capital and depends on the cost of the various sources of funds. A firm may borrow from a variety of sources and may issue preferred and common stock to raise funds. Lenders and stockholders are not altruistic. Creditors demand interest payments, and stockholders want to return from dividend and price appreciation. All sources of funds have a cost. So the question becomes, what is the best combination of debt and equity financing that minimize the firm's cost of capital? That combination is referred to as the firm's optimal capital structure. And this chapter 21 is concerned with the determination of the cost of capital, the firm's optimal capital structure. And chapter 22 uses the cost of capital to select among various competing uses for the firm's capital. So what is the components of the cost of capital? Although the use of financial leverage may increase the return on the stockholders' equity, it may also increase the risk associated with the firm. This suggests a question: what is the best combination of debt and equity financing? This best combination of the firm's sources of finance is its optimal capital structure. The optimal capital structure takes advantage of financial leverage without unduly increasing financial risks. In fact, it minimizes the overall cost of finance to the firm. To determine the optimal capital structure, the financial manager must first establish the cost of each source of finance and then determine which combination of these sources minimizes the overall cost. The minimum cost of capital is important because the financial manager must be able to judge investment opportunities. The selection of the investments requires knowledge of the firm's cost of capital because an investment must earn a return sufficient to cover the cost of the funds used to acquire the asset. Thus, determination of the firm's cost of capital is necessary for the correct application for the capital budgeting techniques that are explained in the next chapter, which is chapter 22. So, cost of capital is the cost of funds used to finance the purchase of assets. All sorts of funds have a cost, and we in the balance sheet we have assets parts and liabilities parts and equity part. So, in order we need to the companies need to finance its assets by using debt, long-term or short-term debt, or equity. So, but each component of this financial statement has different costs. So it involves cost of capital involves debt, cost of preferred equity, and cost of a common equity. Optimum capital structure is the best combination of debt and equity to finance assets. The big question is, what is the best combination of debt and equity that minimize the firm's cost of capital? So let's look at the cost of debt. The effective after-tax cost of debt is represented by RD, depends on the interest rate, and the corporate income tax rate, and the risk. For a given risk class, the after-tax cost is, this is the cost of cost of debt, equals the interest rate 1 minus tax rate. Why we are subtracting tax rate? Because tax enables a tax shield, meaning that the higher the tax, the lower the tax base that companies are paying taxes on that level, because the company is paying taxes after tax deduction. So we need to take care of tax rate in order to compute the cost of debt. So as is explained in the previous chapter, the effective after tax cost of debt is RD, depends on interest rate, and the corporate income tax, and risk. For a given risk class, the after-tax cost is represented by this equation. And let me clean here. And for example, if a firm interest rate is 8.3% and the tax rate is 35%, the cost of that is calculated by the following equation. So we have interest rate multiplied by 1 minus tax rate, which is debt. Cost of debt. So factors affecting the cost of debt is flotation cost. I will explain this term, and short term versus long term, and the leverage and default risk. So notice that the cost of debt is not the interest rate, but the interest rate adjusted for the tax write-off of the interest expense. Also notice that the cost of debt depends on the current rate of interest. It's not the interest rate at which the firm issued debt in the past. If a firm has debt outstanding that was issued 10 years ago with a fixed interest rate above or below the current interest rate, it is the current interest rate that is used to determine the firm's current cost of capital. When the older debt was issued, the previous rate was issued to determine the firm's cost of capital at the time. Current cost is the interest rate that the firm must presently pay to borrow the money, adjusted for the current tax deduction. So the cost of that is affected by any flotation cost, this one, associated with issuing new securities, and by the term of the debt. Flotation cost paid to investment bankers. The companies paid the flotation cost to investment bankers. Bankers reduce the proceeds of the sale and increase the interest cost of cost per dollar borrowed. The larger the flotation cost, the greater the effective interest rate will be. The flotation cost is the cost that companies pay for investment bankers in order to issue new stocks. So the cost of that also depends on its term, long term versus short term. Short term debt generally carries a lower yield, lower interest cost than long term debt. If the firm issues long term debt, the interest expense will probably be higher than if the firm had used short term financing. However, by using long term debt, the firm avoids the problem of retiring or rolling over, in other words, refunding short-term debt, thus avoiding the risk associated with the refinancing short-term debt. And the cost of that also depends on the riskiness of the firm. How risky is the firm? The risk is related to the nature of the business. We call it business risk, and to the use of financial leverage. We call it financial risk. The more the firm uses debt financing, the greater will be the potential for it to fail to meet its debt obligations. This increase in the risk of default means that as the firm's use of financial leverage increase, the interest rate on borrowed money will increase. Okay. How about cost of preferred stock? So the price or value of preferred stock depends on the dividend and yield required to induce investors to buy the shares. So the equation for the valuation of the perpetual preferred stock is, as you see, this is dividend, this is the required return. So P underscore P is the price of preferred stock, price of preferred stock, and D underscore P is the dividend paid by the preferred stock, and R underscore P is the return required by investors, return required by investors to induce them to buy the preferred stock. So the equation may be rearranged to isolate the yield or the firm's cost of preferred stock. So how can we find the required return for preferred stock? We just simple math manipulation. You just transfer RP here and price of preferred stock here. Just as you see, P price of preferred stock is equals to dividend paid divided by return required. I just put R here, so RP is equals to dividend paid over price of preferred stock. So after a little transition and manipulation, we can obtain the cost of preferred stock. The required rate of return for preferred stock is illustrated here. Okay, the third component for cost of capital is cost of common equity. The cost of common stock is the return required by investors to buy the firm's common stock. This cost of common equity is the opportunity cost. It is return that investors could earn on comparable alternatives of their money. This cost applies both to existing shares and to new shares being issued by the firm. Since the cost of common stock is opportunity cost, there is no identifiable expense such as interest that the financial manager may use to determine the cost of these funds. However, the financial manager knows that the cost of common stock exceeds the cost of debt. How he knows that, or she knows that? The no tax advantage is associated with the equity because dividends are paid in after-tax dollars. In other words, dividends are not tax deductible, while interest is paid in before-tax dollars. Meaning, interest is tax-deductible expense. This is the main part that differentiate the cost of debt and cost of equity. In addition, common stock represents ownership, and therefore it's a riskier security than the firm's debt obligations. Although the firm is legally obligated to pay interest and meet the terms of indentures of its debt agreements, there is no legal obligation for the firms to pay dividends. They don't, the companies, the corporations, they don't have any legal obligation to pay dividends. So since equity is riskier than debt to the investors, one means to estimate the cost of equity is to start with the interest rate paid to the holders of debt and at the risk premium. In this specification, the cost of equity is, we can write it, cost of equity equals some interest plus risk premium. So here R underscore E is the cost of equity. Cost of equity. Cost of equity. And I is the interest rate. Interest rate being paid on new issues of debt, the current rate of interest adjusted for the tax advantage. Okay. The risk premium associated with the common stock is then added to the interest rate. Although the financial manager knows the interest rate, the amount of the risk premium is not known. Quantifying the amount of risk premium could be considered making an educated guess, or if you are seeing a matter of conjecture. And an alternative approach to determination of the cost of equity is the capital as a pricing model, where you remember in Chapter 8 and Chapter 11 to value the common stock. So as we know, capital as a pricing model, we can find the cost of equity is equal to risk-free rate plus beta multiplied the difference, the market risk premium, which is the difference between market return and risk-free return. So let's solve an example. So a firm has a beta 1.12. The current S&P 500 return is 7%, which is market return, and risk-free rate is 3%. So let me write risk-free rate is 3%, market return is 7%, and the cost of equity so we need to calculate the cost of equity. How can we calculate cost of equity? We already know cost of equity is risk-free rate plus beta, market return minus risk-free rate. We know beta, we know market return, we know risk-free rate. So we simply find risk-free rate is 3%, beta is 1.12 multiplied by the difference between market return and risk-free rate. So we find cost of equity 7.48%. This is one way, and the other way, we can use dividend pricing model in order to calculate return on cost of equity for common stock. The first way is capital as a pricing model. The alternative way is dividend pricing model. In the dividend pricing model, as you remember, we have price of common equity equals dividend at time 1 divided by return on equity minus growth rate. I'm pretty sure you remember this this equation. So this is dividend paid in time 1. This is price at time 0. This is cost of equity, and this is the growth rate. So how can we find the cost of equity? So just simply I manipulate this equation, and return equity minus growth rate equals dividend paid in time 1 over price 0. And let me clean here. And so as we manipulate this equation into this, so cost of equity is equals dividend paid in time 1 over price 0 plus growth rate. What is dividend 1? This is simply dividend 0 multiplied by 1 plus growth rate. So I write the same, price 0 plus growth rate equals return on equity. So the one way you can calculate the cost of common equity by using capital asset pricing model, which is this cost of equity is risk-free rate plus beta market return minus risk-free rate, one option. And the other option is you can use just simply dividend pricing model and using this equation. This is the second way. Okay. So let's solve the problem. A firm's common stock is paying a dividend 1.15 per share, and the dividend will grow 5% annually. The firm's current price is 27. What is the cost of equity of this firm? Assuming that the dividend growth rate equal to firm earnings growth rate. So how can you find this? So you know dividend times 0 is 1.15. This is growth rate. So simply the numerator just try to calculate the dividend paid in time 1. This is the price at time 0, the price of stock at time 0. This is the growth rate. So simply cost of equity is calculated as 9.47%. Okay. So this tells the manager that the firm's cost of capital equals to, let me clean here. So this tells the manager that the firm's cost of capital equals to 4.47% dividend yield. Here is dividend time 1, price times 0. So dividend at time 1 paid over price 0 is the dividend yield plus 5%, which is growth rate, 5% growth rate. The cost of equity can be viewed from the standpoint of the managers or investors. The investors' required return is the cost of equity to the firm. Failure to meet the cost will result in a lower value of the stock, as the investors will move their funds to alternative investments. Okay. In the previous example, if the firm has exhausted its retained earnings and must issue new stock, the cost of equity must rise to cover the flotation cost. If the flotation cost is $2 a share, what is the new cost of equity? So we need to take care of the flotation cost. Same calculation. We need to write dividend 1 over over the price 0 minus flotation cost. This is flotation cost, patient cost goes to investment banker for their service, for their issuing new stock. Because if the company want to issue new stock, the company, the corporation or firm needs to go a bank, investment bank like Bank of America or Merrill Lynch or other companies, other financial institutions. They will issue, let's say Merrill Lynch, they will issue stock. Okay, so there's a cost. So if the firm nets $25 per share, let me clean here. Yeah, as you see, this is dividend, growth rate, this is price zero, flotation cost, and growth rate. So now the cost of equity is higher than the previous example, right? Because the company paying flotation cost. So the cost of equity is now higher. The firm must earn 9.83% in order to cover the flotation cost and investor required return. Okay, so how can we find a weighted average of return on equity and debt? A return on equity, cost of equity can be divided in two parts. Preferred stock and common stock, and you have cost of debt. So in capital structure, we have three different cost items. So cost of capital is weighted average cost of debt, preferred stock, and common stock. Preferred stock, common stock, and debt. And the weight depends on the proportion of the firm's assets financed by each source. So let's say the assets, we have liabilities, and equity. Let's say we have some cash and cash equivalents, inventory. We have PPE, which is plant, property, and equipment, like machines to manufacture what the company is producing, and short-term debt, long-term debt, and equity. So equity involves preferred stock and common stock, right? If the company finance its assets, let's say 100% debt, we just write here 0%, 0% cost of equity, and 100% cost of debt. Or let's say 5%, 5%, 90%, etc. Let's see the formula again. I just want to see the formula. As you see, this is cost of capital. We can, in other words, this is weighted average cost of capital. This is weight of debt, cost of debt, weight of preferred stock, cost of preferred stock, weight of equity, weight of common equity, and cost of common equity. So the goal is to minimize the WACC, the weighted average cost of capital, thus maximizing the value of the shareholders' interest in the firm. Okay. As you see, so let's say the proportion of debt is 0, proportion of equity is 100%, cost of debt is 4%, and cost of equity is 10%. What is WACC? What is the weighted average cost of capital? We simply multiply the proportion of debt, cost of debt, and the proportion of equity, cost of equity. As this is 0, we don't have any cost from debt. We only multiply by proportion of equity, 100%, and cost of equity, 10%. So the WACC is 10%. So same, let's say 90%, 15%, 10%, 20%. Just multiply 2 and multiplication, and we sum two multiplicated values, and we find 15%, 0.7. So what is the optimal capital structure? The bottom line, we try to find the optimal ratio from equity and debt, and we try to minimize the average cost of capital. So if the company use 100% equity, this is the uh, cost of capital. If the company use 100% debt, this is the cost of capital. So we try to minimize the cost of capital by using the correct proportion of equity and debt, or optimal proportion of equity and debt, and we try to find the minimum level of this line, which involves some portion of equity, some portion of debt. So if the firm is entirely financed by equity, the weighted average cost of capital equals the cost of equity, this one. If the firm substitutes the cheap debt financing of equity financing, the weighted average cost of capital begins to decrease. However, as the firm leverage level increases, leverage means debt ratio, debt over assets. Level increases, the firm becomes riskier, and eventually the firm's cost of capital will rise. So there exists an optimal point or range at which the firm's cost of capital is lowest, the bottom of this curve. Let's solve a problem 1. The expected return on target equity is 11.5%, and the firm has yield of maturity on its debt 6%, and debt accounts for 18%, and equity is 82% of the target's total market value. Okay, if the tax rate is 35%, what is the firm's weighted average cost of capital? Okay, let's try to solve this problem. So we've tried to find weighted average cost of capital. We have proportion of debt, we have cost of debt, we have proportion of equity, we have cost of equity. So why we write this term here is that this is tax shield. In other words, we need to take care of interest paid in debt, and because this interest is paid in tax is subtracted from the cost. So what is the calculation? So as you see, the proportion of that is 18%, cost of that is 6%, the tax interest rate is 35%, and 0.82 is the proportion of equity, and the cost of equity is 11.5%. So when you do the calculation, we find the 10.1% weighted average cost of capital. Okay. Let's solve problem 2. Okay, let's solve problem 2. In mid-2013, the market value of the DuPont common stock, preferred stock, and the debt were 52. Okay, 52. Okay, 52. Okay, 52.240 million, this is the common stock, preferred stock, and debt. So common stock is 52.2 million, and preferred stock is 221 million, and debt is 14. So the company has beta 1.09. the market risk premium is already given, which is RM minus RF, market return and risk-free rate. So this is the market risk premium, which is 5.6%. Risk-free rate is 4%. Okay. The yield to maturity of the company bond is 6.25%, and tax rate is 35%. Okay. And the company preferred stock was priced at $46, and dividend paid on the preferred stock is 2.8 per share. What is the DuPont weighted average cost of capital? Okay, we try to find the overall total assets by adding up the preferred stock, common stock, and this is the common stock, preferred stock, and debt values in order to find the total assets, because you remember this is assets, liabilities, equities. When you sum the debt and preferred and common equity, you will find the assets, because the value should be equal for each side's assets should be equal liabilities and equity. If you sum two items of financial situation balance sheet, you will find the total assets. So we just sum them up, and we find the total assets is 541 million. And why we're adding up? Because we need to find the weights of equity. So this is total assets, and 53,240 is the equity, total equity. So we find the proportion of equity, 78%. Similarly, we try to find the preferred equity, the weight of preferred equity. This is we have 210 preferred equity divided by total assets. We find the proportion of preferred equity, and then finally we look at the debt. So the total debt is 14,000 over 67,000, and we find that proportion 20%. Okay. And as we need to use these weights in order to compute the weighted average cost of capital, first we calculate the weights of each item. Then we try to find cost of equity, cost of preferred equity, and debt. So cost of equity calculation, we use CAPM model, capital pricing model. So here, CAPM model gives us return equity equals risk-free rate plus beta, the difference between market return and risk-free rate. It's already given. Here is already given, which is 5%, 5.6%, right? This is the market risk premium. Beta is given as 1.09, and risk-free rate is 4%. So we find cost of equity here, and then we already compute cost of equity here. This part is weight, the proportion of equity multiplied by cost of equity. Second part here is preferred equity, weight of preferred equity multiplied by the cost of equity. So what is the weight of preferred equity? Is 0.32%, which is 0.0032. How can we calculate the preferred cost of preferred equity, which is the dividend paid per share 2.8 divided by the price of share. Price. What was the stock price? Let's go the previous. Yeah. So what is the dividend paid on preferred stock is 2.8 per share, and the stock price is 46. Okay, let's go. Yes. So stock price is 46. Dividend paid is per share is 2.8. What is the percentage? Okay, this is the cost of preferred stock, dividend over price of preferred stock. And the last part here, I will use different color, and this part is the debt calculation, right? Let me clean this mess. Okay, now we calculate. Okay, we already understand this part. This is equity multiply this. This is weight of preferred stock multiplied by cost of preferred stock here. And the last part is the weight of debt and multiplied by we try to find cost of debt. How can we find cost of debt? The interest multiplied by 1 minus tax rate. The interest rate is 6.25 multiplied by 1 minus tax rate. The tax rate is 35%. So we calculate cost of debt here. This is the weight. This is weight. Here is, let me write here, 0.0625 multiplied by 1 minus tax. Tax is 0.35%. So we find the proportion of debt and cost of debt, this part. Finally, and hopefully, you should find 8.83%, which is weighted average cost of capital. If you understand this problem, that means you understand whole chapter. Okay, let's go next page. So wrap up. We try to give the answer of these following questions. What are the components of cost of capital? Equity, debt, and equity can preferred equity, common equity. And why is the cost of capital important? And how can a financial manager find the optimal structure of a firm? We apply back calculation, weighted average cost of capital calculation. So please read your notes, PowerPoint slides, and chapter 13 and 21. Please go Engage learning page under the content folder on Blackboard, and do the mind type exercises, quizzes, video reviews. They already, and the Engage learning already has PowerPoint slides and flashcards. I think they are so useful. And all the questions will come from the mind type exercises, quizzes, plus book exercises at the end of the each chapter. So that's all for today. Thank you for your attention, and see you next time.